January 12th, 2026. Silver breaks $85 per ounce. Shanghai hits $93. The paper market trembles. Physical demand explodes. Then, at 11:47 p.m., while most were asleep, the Chicago Mercantile Exchange sent out a notice, an emergency margin notice, effective immediately. No warning, no discussion, no explanation. By Tuesday morning, silver crashed 4.2% in 90 minutes. Billions in retail positions, liquidated. The big banks, the ones losing fortunes on short positions, suddenly protected. This wasn't a market correction. This was surgical intervention. And what they did next, we'll show you exactly how deep the manipulation goes. Welcome to Currency Archive. If you've been following financial markets for a few decades now, if you remember when markets actually made sense, when rules weren't changed overnight to protect the institutions, then you know this channel speaks your language. We don't do hype here. We do analysis. Cold, hard, documented analysis. If you value that, if you want someone cutting through the noise and showing you what's really happening with your wealth, take a moment and subscribe. It's just one click, but it tells us you're serious about protecting what you've built. And before we dive deep into what happened Monday night, drop a comment below and let us know. Where are you watching from today? New York, London, Singapore, Mumbai? We want to know where our serious investors are located. Now, let's break down exactly how they rigged the game. January 12th, 2026 will be remembered as the day the silver market revealed its true nature to anyone paying attention. That morning, traders around the world watched something extraordinary unfold. Silver prices on the COMEX exchange pushed through the $85 per ounce barrier. This wasn't just another price movement. This was a psychological threshold that had been defended for months by institutional short sellers who stood to lose billions if silver continued climbing. Simultaneously across the Pacific Ocean, the Shanghai Futures Exchange told a different story. Physical silver was trading at $93 per ounce. The gap between paper silver in New York and physical silver in Shanghai had widened to 8.6%. For context, a 2% divergence is considered unusual. An 8.6% spread suggested something was fundamentally breaking in the global silver market. Throughout that Monday, the financial community buzzed with analysis. Some declared the death of arbitrage between Eastern and Western markets. Others pointed to physical delivery demands overwhelming the paper system. The consensus among physical silver advocates was clear. The system was cracking. Then night fell on the east coast of America. At precisely 11:47 p.m. Eastern Standard Time, while most retail traders were sleeping, the Chicago Mercantile Exchange issued an emergency notice. The document landed in professional inboxes with bureaucratic precision. Its title was technical, a margin notice advisory, but its implications were devastating. The CME group, which controls the COMEX futures market where silver prices are determined, announced immediate changes to margin requirements. Not changes scheduled for next week, not changes pending regulatory review, changes effective at the opening bell Tuesday morning, less than 9 hours away. Here's what most people don't understand about futures trading. When someone buys a futures contract, they don't pay the full value of the commodity. They post a margin, essentially a good faith deposit. There are two types. Initial margin is what's required to open a position. Maintenance margin is the minimum amount needed to keep that position open. The CME slashed both. Under normal circumstances, margin changes are announced 5 to 7 business days before implementation. This gives traders time to adjust positions, add capital, or exit gracefully. The last time the CME implemented same-day emergency margin changes was March 2020 during the COVID market collapse. But here's where it gets interesting. When exchanges reduce margin requirements, the public assumes it makes trading easier, more accessible. In reality, emergency margin cuts during a rally serve a different purpose entirely. They trigger a psychological panic among leveraged traders who suddenly question whether the exchange knows something they do not. The math was brutal and immediate. Tuesday morning, January 13th, the COMEX silver market opened with a gap down. The price that closed Monday near $85 opened Tuesday at $82.40. Within the first 90 minutes of trading, silver plunged to $81.30, a 4.2% collapse. Trading volume told the real story. Normally, the first hour of silver trading sees moderate volume as institutions position themselves. That Tuesday morning, volume spiked 340% above average. This wasn't normal profit taking. This was forced liquidation. When margin requirements change suddenly, traders operating on leverage face immediate margin calls. The broker's message is simple: deposit more cash within the hour, or your position gets liquidated at market price. For retail traders, that hour might arrive at 3 a.m. local time. By the time they wake up and check their accounts, the liquidation has already happened. The cascade effect is mathematically predictable. Trader A gets liquidated, creating selling pressure. That selling pressure drops the price further, triggering margin calls for trader B, C, and D. Each liquidation triggers the next. Within 90 minutes, thousands of retail positions were wiped out. Meanwhile, institutional players, the major banks and trading houses with dedicated margin desks and pre-positioned capital, had 9 hours of advance notice. 9 hours to adjust hedges, secure credit lines, and prepare for volatility. The bid-ask spread, normally 2 or 3 cents, exploded to 40 cents as market makers withdrew liquidity. This meant retail traders trying to exit positions were selling into a vacuum, getting filled at prices far worse than they saw on their screens. By 11:30 a.m. Tuesday, the bloodbath was complete. Silver stabilized around $81, having destroyed an estimated $2.3 billion in retail long positions. And the institutions with massive short positions, the ones facing catastrophic losses at $85 silver, they just got a lifeline. But why? 3 months earlier, in October 2025, a document was filed with the Commodity Futures Trading Commission that most people never bothered to read. It was called the Bank Participation Report. Buried in the technical language and data tables was a number that should have alarmed anyone paying attention. 4 major U.S. banks held combined short positions in silver futures equivalent to 298 million ounces. To put that in perspective, that's roughly 40% of total annual global silver mine production concentrated in the hands of just 4 institutions. Bets that silver prices would fall. And by January 12, 2026, when silver touched $85 per ounce, those bets had gone catastrophically wrong. The mathematics of their predicament was straightforward and terrifying. When these positions were initially established, silver was trading in the 22 to 26 range throughout 2023 and early 2024. Some positions dated back even further to the 18 range. At $85 silver, the mark-to-market losses on a 298 million ounce short position exceeded $17 billion. Not million, billion with a B. But here's what made the situation truly dangerous for the financial system. These 4 banks didn't operate in isolation. They were counterparties to hundreds of other financial institutions through the derivatives market. Their silver positions were collateralized against other assets. Their credit lines supported trading operations across multiple commodity markets. A forced closure of these short positions at 85 plus silver wouldn't just hurt the banks. It would send shockwaves through the entire commodity derivatives complex. Wall Street has a name for this situation. They call it systemic risk. Financial regulators have a different name. They call it Tuesday. The decision to slash margins wasn't made in a vacuum. It was made in conference rooms where the question wasn't whether to intervene, but how to intervene without making it obvious. Emergency margin increases would have been the traditional tool. Force traders to post more capital, squeeze out the speculators, drive prices down. That's what happened in 2011 when silver approached $50. The CME raised margins 5 times in 8 trading days. Silver crashed from $49 to $32 within weeks. But 2026 wasn't 2011. The market structure had changed fundamentally. Physical demand from industrial users, solar panel manufacturers, electronics companies, and Eastern buyers had created a floor under prices. Raising margins in a physically tight market risked accelerating the very crisis the intervention was meant to prevent. Higher margins meant fewer traders willing to provide liquidity. Less liquidity meant wider spreads. Wider spreads meant institutional shorts couldn't exit even if they wanted to. So they chose the opposite approach: slash margins. Create confusion, trigger psychological panic among retail traders while giving institutions the cover story they needed. The exchange reduced margins, so we adjusted our risk parameters accordingly. Perfectly legal, perfectly defendable, perfectly devastating to anyone caught on the wrong side. The timing revealed the coordination. 11:47 p.m. on a Monday night. Late enough that retail traders in America were asleep. Early enough that Asian markets hadn't opened yet. The Hong Kong exchange was closed. Shanghai wouldn't open for hours. London was asleep. Only the institutional trading desks with 24-hour operations and direct CME communication channels were positioned to react. By Tuesday morning in New York, the major banks had already adjusted their positions. They'd covered some shorts at lower prices during overnight electronic trading. They'd repositioned hedges. They'd secured additional credit lines from their clearing members. When retail traders woke up to margin calls, the institutional money had already executed its strategy. Historical data shows a pattern that's impossible to ignore. Every major rally in silver over the past 15 years has been met with exchange intervention. 2011, 5 margin hikes. 2020, emergency margin adjustments during COVID. 2024, position limit changes that disproportionately affected long speculators. And now 2026, emergency margin cuts designed to shake out leveraged retail money. The regulatory framework permits this because the CME operates as a self-regulatory organization. They set their own margin requirements. They adjust them at their own discretion. The CFTC provides oversight, but that oversight focuses on systemic stability, not fairness to retail participants. If a margin change prevents a derivatives crisis that could threaten major banks, regulators consider that a success regardless of who gets hurt. Meanwhile, in Shanghai, something completely different was happening. The physical silver price barely flinched. While COMEX paper, silver crashed from $85 to $81. Shanghai silver dipped only to $91, then recovered to $92.50 by end of day. The divergence that had been 8.6% on Monday had now widened to nearly 12%. This was unprecedented. The paper market and physical market were no longer just diverging. They were operating as completely separate pricing mechanisms. And that separation was about to reveal something the institutional shorts never anticipated. There's a moment in every market crisis when the machinery of finance reveals itself for what it truly is. Not an elegant system of price discovery and efficient capital allocation like the textbooks describe, but a mechanical trap designed to extract wealth from those who don't understand the rules. That moment arrived at 9:30 a.m. Eastern Time on Tuesday, January 13th, 2026. A retirement account holder in Phoenix, Arizona received an automated email from his brokerage firm. The subject line read, "Urgent margin call. Immediate action required." He'd been holding 5 silver futures contracts, purchased at $78 per ounce 3 weeks earlier. His account showed a healthy profit on Monday evening. By Tuesday morning, that profit had evaporated, and he now owed his broker $14,200 within 60 minutes, or face-forced liquidation. He wasn't alone. Across North America, Europe, and Asia, thousands of similar emails landed in inboxes. Some traders were already awake and panicking. Others were still sleeping, unaware that a countdown clock had started ticking the moment the margin notice hit their accounts. Here's the mechanical reality of a margin call in futures markets. When an account falls below maintenance margin requirements, the broker issues a margin call. The trader has a limited time window to deposit additional funds. If those funds don't arrive, the broker has legal authority to liquidate positions immediately at whatever price the market offers. The trader has no say in the timing, no ability to wait for a better price, no negotiation. In normal market conditions, the system works reasonably well. Prices move gradually. Traders have time to make decisions. Market makers provide liquidity, so positions can be closed near the displayed bid price. Tuesday morning wasn't normal market conditions. The Phoenix trader tried to call his broker at 9:32 a.m. The phone system played a recorded message about unusually high call volumes. He attempted to log into the trading platform to close his positions voluntarily before liquidation. The platform was slow, overwhelmed by traffic. By the time he accessed his account at 9:44 a.m., his positions had already been liquidated at $81.15 per ounce. The market price showing on his screen at that moment was $81.90. That 75-cent difference between his liquidation price and the displayed market price represented an additional $18,750 in losses beyond what the market movement alone should have caused. This wasn't theft. This was slippage, the technical term for the difference between expected execution price and actual execution price in illiquid markets. And liquidity had vanished completely. Market makers are the institutions that provide continuous bid and offer prices in futures markets. They profit from the spread between buying and selling prices. In exchange for this profit, they accept an obligation to maintain orderly markets even during volatility. But that obligation has limits written into their contracts with the exchange. When volatility exceeds certain thresholds, market makers can legally withdraw or widen their spreads dramatically. Tuesday morning, they did both. The normal bid-ask spread in silver futures is typically 2 to 3 cents. By 9:35 a.m., that spread had widened to 43 cents. At 9:47 a.m., during the peak of forced liquidations, the spread briefly touched 62 cents. For retail traders getting automatically liquidated, this meant selling at prices up to 75 cents below where they thought the market was trading. Multiply that 75 cents across the estimated 47,000 retail silver futures contracts that were liquidated Tuesday morning. The additional slippage cost alone exceeded $176 million. That money didn't disappear. It transferred to the market makers and institutions positioned on the other side of those panicked sales. The cascade effect followed textbook mechanics. Trader A gets liquidated, dumping 5 contracts into the market. The selling pressure drops the price by 10 cents. That 10-cent drop triggers margin calls for traders B, C, and D, who were barely above maintenance margin. Their liquidations dropped the price another 15 cents. That triggers the next wave. Within 90 minutes, the cascade had consumed itself, leaving silver down 4.2% and thousands of accounts zeroed out. An institutional trader at a major commodity desk later described that morning in an anonymous interview with a financial blog. His desk had received the margin notice at 11:52 p.m. Monday night, 5 minutes after it was issued. By midnight, they had conference calls running with their clearing firm, their risk management team, and their credit department. By 3 a.m., they had secured an additional $50 million credit line specifically to weather potential volatility. By 9 a.m., before the market even opened, they had repositioned hedges and established limit orders to buy silver at multiple price levels below the market. When the liquidation wave hit at 9:30 a.m., this institutional desk was a buyer. They accumulated around 200 contracts between $81.15 and $81.85. Contracts that retail traders were forced to dump at the worst possible prices. By end of day, when silver recovered to $83.20, those more 200 contracts were showing a profit of $8.4 million. This wasn't superior trading skill. This was superior information and superior capital access. The psychological impact extended beyond just the financial losses. Chat rooms and social media filled with silver traders questioning everything. Did I miss something fundamental? Was the rally fake? Are the bullish fundamentals wrong? The margin cut had achieved its secondary objective, creating doubt in the minds of retail participants about whether the silver thesis was even valid. But here's what none of those liquidated traders could see from their destroyed account statements. The physical market hadn't changed at all. Industrial silver demand projections remained the same. Solar panel manufacturers still needed 140 million ounces annually. Electronics companies still required 240 million ounces. Defense contractors still demanded high-purity silver for military applications. Global mine supply still faced declining ore grades and years of underinvestment. The fundamentals supporting higher silver prices were completely intact. Only the paper price had been manipulated downward through mechanical liquidation cascades enabled by emergency margin changes. And in Shanghai, where physical metal actually trades hands, the price held firm above $91. The wealth transfer was complete. The trap had been sprung. The question now became whether anyone would learn the lesson being taught, or whether they'd simply blame themselves for poor risk management. In 1971, President Richard Nixon closed the gold window, severing the dollar's last connection to physical metal. The decision was presented as temporary. 55 years later, that temporary measure has become the foundation of the modern monetary system. What few people understood then, and fewer understand now, is that closing the gold window didn't eliminate the role of precious metals in global finance. It simply moved that role into the shadows, where price discovery happens not in physical vaults, but in paper contracts traded on screens. The events of January 12th and 13th, 2026 revealed something that should concern anyone holding wealth in any form. That shadow system is breaking. Price discovery is supposed to be the most fundamental function of markets. A seller offers a commodity. A buyer bids for it. Through the interaction of supply and demand, a price emerges that reflects genuine value. For centuries, this mechanism worked reasonably well for precious metals. Silver traded where physical metal changed hands. In London vaults, Zurich depositories, and later on commodity exchanges where contracts were settled with actual deliveries. But modern silver markets operate differently. The COMEX in New York trades roughly 150 million ounces of paper silver every single day. Annual global silver mine production is approximately 850 million ounces. This means the paper market trades nearly 2 months of global production daily, most of it with no intention of ever taking physical delivery. The prices generated by this paper trading are then used to value physical silver sitting in vaults worldwide. The system works only as long as participants believe paper and physical are equivalent. Tuesday morning shattered that belief for anyone paying attention. When COMEX silver crashed 4.2% while Shanghai physical silver barely moved, the divergence became impossible to ignore. This wasn't a temporary arbitrage opportunity that traders could exploit for profit. Arbitrage requires the ability to buy in the cheap market and simultaneously sell in the expensive market, pocketing the difference. But the Shanghai market wasn't freely accessible to Western traders. And even if it were, the logistics of shipping physical silver across the Pacific takes weeks, not hours. The two markets were decoupling in real time. Financial historians have seen this pattern before, though not in living memory for most traders. In the 1960s, a similar divergence developed between official gold prices and free market gold prices. The London Gold Pool was established by central banks to suppress free market gold prices and maintain the official 35 per ounce peg. For 7 years, central banks dumped gold into the market every time prices rose. The pool collapsed in March 1968 when physical demand overwhelmed the available supply. Within 3 years, gold had broken free of all official price constraints. Silver in 2026 is following an eerily similar trajectory. The institutional short positions that necessitated Tuesday's margin intervention represent a modern version of the London Gold Pool. Major banks have been systematically shorting silver futures, effectively suppressing prices below where physical supply and demand would naturally settle. The strategy worked for years because most silver trading was paper trading. As long as participants were satisfied with cash settlements and didn't demand physical delivery, the banks could maintain short positions indefinitely. But the game changes when physical demand exceeds available supply. Industrial users cannot manufacture solar panels with paper silver. Electronics companies cannot build circuit boards with COMEX contracts. Defense contractors cannot produce missiles with promises of future delivery. They need actual metal. And increasingly, they're struggling to source it at anywhere near the COMEX price. Reports from physical dealers tell a consistent story. A solar panel manufacturer in Germany recently contracted for 500,000 ounces of physical silver. The negotiated price was $87 per ounce with delivery in 6 weeks. At the time of the contract, COMEX silver was trading at $79. The manufacturer didn't care about the COMEX price. They cared about securing the metal needed for production. The physical market had detached from the paper market even before Tuesday's margin manipulation. This creates a systemic risk that extends far beyond silver prices. The entire commodity derivatives complex operates on the assumption that paper contracts reflect underlying physical reality. If that assumption breaks down for silver, what does it mean for gold, copper, platinum, palladium? What does it mean for oil futures, agricultural commodities, and the hundreds of trillions of dollars in derivatives that theoretically hedge physical business operations? The Basel III banking regulations, implemented globally between 2019 and 2023, were supposed to address exactly this kind of risk. Under Basel III, physical gold held in bank vaults counts as a Tier 1 asset, the same category as cash. Paper gold derivatives do not. The regulation forced banks to restructure their precious metals holdings, moving away from unallocated paper positions toward physical metal. Silver hasn't received the same regulatory treatment yet, but the market is imposing its own version of Basel III through price divergence. Eastern buyers, particularly Chinese institutions and Middle Eastern sovereign wealth funds, have shown an increasing preference for physical metal held in jurisdictions outside Western banking systems. When Shanghai silver trades at $92, while New York silver trades at $81, that $11 premium represents the market's assessment of counterparty risk, delivery risk, and jurisdictional risk in the Western paper system. For strategic investors, Tuesday's events offer a clear lesson. The choice is no longer between buying silver at 81 Rs or 085. The choice is between participating in a paper market where rules change overnight to protect institutional losses, or securing physical metal in a market where prices reflect genuine scarcity, but availability is increasingly constrained. The timeline for this market structure breakdown is compressing. Physical silver inventories in COMEX warehouses have declined 34% over the past 18 months. Registered silver, the portion available for delivery against futures contracts, has fallen even more dramatically. At current industrial demand rates and declining mine output, the physical deficit is mathematically unsustainable within 3 to 5 years. 3 possible outcomes exist from here. First scenario, the paper market reasserts control through continued intervention, margin manipulation, and regulatory pressure. Prices remain suppressed indefinitely while the physical market operates as a parallel system at higher prices. This is the current trajectory. Second scenario, a major delivery default at COMEX or LBMA forces a repricing of paper contracts to match physical reality. This would be sudden, disorderly, and devastating to anyone holding short positions or unallocated paper silver. Third scenario, a gradual decoupling continues until the paper market becomes irrelevant to physical silver pricing. Shanghai, or perhaps a new Middle Eastern exchange, becomes the global price-setting mechanism while Western paper markets fade into obscurity. History suggests the second scenario is most likely. Systems that rely on manipulation and intervention eventually face a moment where the manipulation fails. The energy required to maintain artificial prices increases exponentially until a breaking point arrives. Tuesday's margin/bought time for institutional shorts. It did not change the underlying supply-demand imbalance driving prices higher. The question facing serious investors isn't whether to own silver. The question is whether to own paper promises or physical metal, and whether to make that decision before the choice is made for them.